If you look at Wall Street today, you would think the American financial system is invincible. The stock market is setting new all-time highs, and investors are celebrating what appears to be a golden era of corporate profitability. The government's data tells a similar story of success. This chart breaks down the first quarter of 2026. Gross domestic product bounced back from a sluggish 0.5% growth late last year to a solid 2% annual rate. Alongside it, the unemployment rate sits at 4.3%, a figure economists generally consider healthy. The Treasury Department points to trillions of dollars flowing into domestic manufacturing, calling the current environment a policy-driven capex boom. By almost every traditional metric, the system is working. Then you ask the people actually living in it. This graph tracks the University of Michigan Consumer Sentiment Index. In May 2026, the line crashes to 48.2. To understand how extreme that is, we have to pull this timeline back past 2020, all the way to 1952. The current mood of the American consumer sits below every recession, every gas shortage, and every financial crisis of the past 70 years. Gross domestic product is rising, but citizens feel broke. The top-line numbers that define national wealth are actively failing to measure the financial reality on the ground. The explanation for this gap starts with expenses that the gross domestic product ignores. A rising GDP does not cover your morning commute. Global energy markets are currently under immense pressure. The ongoing conflict with Iran has created severe anxieties about the Strait of Hormuz, one of the narrowest and most critical supply chain checkpoints for the world's crude oil. The financial fallout from that geopolitical tension hits the consumer directly. Brent crude oil is hovering near $100 a barrel, and local gas prices have spiked over $6 a gallon in parts of California. On top of fuel costs, consumers are absorbing the compounding effects of aggressive trade policies enacted over a year ago. This step chart visualizes the change in April 2025. The effective tariff rate on imported goods jumps from 2.1% to 11.7%. That represents a 5-fold increase in the tax burden on everything from raw food ingredients to consumer electronics. Even though the Supreme Court later ruled most of these specific tariffs unconstitutional, the damage was already priced in. Retailers already passed the higher costs down to the checkout line, and those prices remained elevated. Combine $100 oil with lingering import taxes, and you get an unrecoverable tax on daily survival. Working-class families across the country are forced to redirect their wages just to maintain their baseline standard of living. High prices alone don't fully explain public exhaustion. Economists point to a phenomenon called sequential shock. It began with the initial COVID-19 lockdowns, which instantly broke global manufacturing and distribution networks. This visual timeline tracks what happened next. The pandemic lockdowns are followed by supply chain chaos, domestic inflation, the 2025 tariff hikes, aggressive interest rate spikes, and the 2026 energy shock. As the Cleveland Fed noted, Americans absorbed a decade's worth of inflation. Watch how these stacked events compress into 5 years. Households never had a window to rebuild their savings between crises. When positive economic data makes headlines today, it lands on an audience that is mathematically and psychologically depleted. You can see that exhaustion in how the public plans for the future. The government insists inflation is cooling, but regular Americans expect prices to rise another 4.5% over the next year. We are seeing the corporate consequences of those fears in real time. McDonald's is warning investors that rising gas prices are heavily depressing customer spending, while Whirlpool is reporting drops in appliance demand that rival a full-blown recession. For recent college graduates, this translates into what analysts call a low-hire economy. The overall unemployment rate may be low, but the corporate openings that offer a path to the middle class are scarce. The last time consumer sentiment fell to these levels, the American middle class was just beginning its post-war expansion. Today, that purchasing power is eroding month by month at the grocery store and the gas pump. High gross domestic product and record-breaking stock markets mean very little to a family that can no longer afford the basics. Moving forward, we must look past the top-line growth and ask the only question that defines a healthy nation: growing for whom?